So we're getting into the merchandise inventory chapter within financial accounting. A pretty big chapter in of itself. Just another asset that we have to learn how to report and basically present on the balance sheet. What cost flow assumptions we have to put in the notes and which one to choose to expense our inventory and so on. So there's a lot of theory that we have to go over in the next few tutorials. And in this one, I just wanted to keep it very general and talk about a few introductory elements to the merchandise inventory chapter. So of course, merchandising and a service company, very different. Service companies, of course, perform services. They're very, you know them as entities like a tax firm or possibly a consulting business. I know many people who want to go into consulting. It looks so fast-paced, how they make it always look on like Fox or NBC. I forget. There's like a couple consulting shows. Maybe it's on HBO. You also have service companies like public accounting, where all the excitement is at. So those are types of service entities. And of course, merchandising. You know your merchandising companies, the big ones like Walmart and Target and Best Buy. And what's different between these two companies is that, of course, they have the inventory part. Because services, they don't have inventory. They sell their expertise or their skills. They sell their services. That's why they're called service companies. So, of course, merchandise companies, they have inventory. They need to report inventory on their balance sheet. And how are they going to do that? They need to figure out how to record it, and it's going to be at the lower of I should have put the one over there, the lower of cost and net realizable value. I'm just going to abbreviate that, but it stands for net realizable value. And basically, so you know what cost is. So if we have 800 units multiplied by $8, then we have $6,400 worth of inventory. So that would be the cost. Net realizable value, on the other hand, is the cost minus any amortization, minus any depreciation, minus any impairment costs. And we're not going to have amortization or depreciation because it's not like a capital asset or a bond, but you might have impairment. And what impairment is basically, it's like, of course, merchandise, it can become obsolete. And when you have obsolescence, maybe the inventory becomes only worth half of what it originally was. So maybe it's worth $3,200. So if you look at $6,400 and $3,200, which one's lower? Well, the $3,200 is lower, and we have to disclose it at $3,200 on the balance sheet because we want to be conservative with our accounting, I guess you could say. And of course, with inventory, what's going to happen is that we're going to purchase inventory, so that's the first part of recording it, but we're also going to sell it. And when we sell it, we're going to have something known as cost of goods sold, and it's pretty straightforward. It's basically it's an expense. It's an expense account. Some people mix this up, but remember, it's an expense account, and it shows up on the income statement. It's basically the cost of everything you sell. So this is an account that is going to be for the year, because everything on the income statement is a temporary account. So the cost of goods sold is basically going to determine how much expense there is associated with your inventory. So how much inventory have you sold? How much did all of that inventory that you sold cost? So on your income statement, it's going to look something like this. Let me just kind of give you some more room. I know this is pretty dry stuff, but I don't know. I guess if you need to go over it, this always helps. So we have net sales minus cost of goods sold, and that's what it's going to look like on the balance sheet. You're going to have your numbers over here, of course. and you will have underneath it something known as gross profit. And gross profit is a technical term which basically is just your sales minus your cost of the sales, and that's going to give you your gross profit. And another name or an interchangeable term for gross is fatty profit, and the reason they call it fatty profit is it's the profit before all the other expenses like the admin expenses and the accounting expenses and the marketing. So all the different period costs, all the costs outside of the inventory process. And then of course, when you subtract all those expenses from gross profit, you will get net profit. So definitely come out of this knowing that there is a big difference between net profit and gross profit. So I think that is mainly what I wanted to cover. I just wanted to show you that, of course, inventory is recorded at the lower of cost and net realizable value, that there is this extra step in the operating cycle of a merchandising company. Know that the cost of goods sold is unique in that it is associated with a merchandising company because merchandising companies have goods to sell. And of course, know the difference between gross profit and net profit. So I'm going to be talking about periodic inventories versus perpetual inventory systems, I think, in the next tutorial. Make sure to subscribe, and I will see you guys in the next tutorial. If you have any questions regarding accounting or any other material within our videos, you can tweet us at Notepirate. You can like us on Facebook to receive updates or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.